Let's talk about risk. No asset class analysis would be complete without a risk assessment. So let's look at the private equity asset class risk and give a few thoughts about it. So we've got two main viewpoints on risk in private equity, the LPs and the GPs. Returns are the same and can be measured in cash. I put money in, I get money out. Risk depends on perception and therefore the identity of the party assessing the risk, which can be different. So let's first take the specific point of view of the LP committing capital to a fund managed by a specific fund manager. We're going to have four broad classes of risk. One, asset class risk. Secondly, portfolio risk. Thirdly, fund manager risk. And fourthly, co-investment risk. Let's look at each of the four categories in turn. Firstly, the asset class set of risks. We have duration risk. Funds require a commitment of 7 to 10 years and distributions may not come for 3 to 5 years. So the LP's liabilities must not be out of line with this. We have liquidity risk. Following his commitment, the LP must hold his position to the end of the fund, even though in recent years the secondaries market has allowed for LPs to get out before the end. We have transparency risk. Private equity funds operate on a blind pool basis, where the LP does not know what the portfolio will be before his commitment is made. This is an opaque aspect not shared by other asset classes and presents particular challenges. We have cash flow risk. Capital calls and distributions are at the discretion of the fund manager and cannot be predicted in advance that easily. We have a risk of mismatch between commitment and investment. The fund manager will rarely deploy all the committed capital because he wants to keep some dry powder, but the LP may have to provide for all his commitment on his balance sheet. We have regulatory risk. Regulations may change and may have tax and other impacts. Look at the current regulations about directors on offshore centres, for example. Secondly, the portfolio class set of risks. We have concentration risk. The LP may allocate too much to a too small number of funds or funds with shared characteristics. We have relationship risk. As time passes, the number of GP relationships an LP has will grow and become difficult to manage. We have default risk. There may be an impact on the funds in the event that an LP defaults on their commitment. Thirdly, let's look at the fund manager class at risks. We have key man risk. The LPs will invest based upon the track record of 1 or 2 or 3 key individuals, and it can be a problem if they withdraw from managing the fund. We have style drift risk. The fund manager may over time drift away from the original strategy, even if legitimately. We have transparency risk. The fund manager has a lot of discretion in the valuation of the portfolio and what and when to report. We have realization risk. Valuations may fluctuate before exit with a consequent uncertainty for LPs and for booking the value of their investments. We have foreign exchange risk. Most funds are denominated in euros or dollars but may invest in other currency, particularly so in emerging markets. Fourthly, co-investment risk category. The LP may make direct investments either alone or with a fund manager. In this case, he will face the whole set of direct investment risks, which would be partially mitigated if he delegates the management of the co-investment to the fund manager on his behalf. Direct investment risks means the whole set of risks involved in investing in the equity of a particular company, but let me not go into the detail of this right here. So we have quite a substantial number of risks to be managed, and some aspects of this are going to be very specific to private equity and quite tricky to really understand. Okay, so we just considered risk from the point of view of the LP. Now let's look at private equity risk from the point of view of the GP, which is a point of view which is different and distinct from the point of view of the LP when it comes to looking at risk. The kind of risks a private equity fund manager faces follows more of a distinct evolution as the fund moves through its life cycle from fundraising through to fully exited. For those bigger firms managing several funds, the risks will be constant as the fund's life cycles will be smoothed out over several funds that the firm does manage. First, fundraising risk. For any GP fundraising, there is considerable risk attached to gaining LP commitments for a new fund. The reasons for this are complicated and lengthy internal decision process of LPs, as well as misrepresentation of interest by LPs towards fundraising GPs. I mean, nobody likes to be negative at a fundraising pitch. This risk can be best managed by aspiring GPs taking advice they may not want to hear from fundraising experts. And I never cease to be amazed by the continued naivety of many aspiring first-time GPs in this particular area. Secondly, default and concentration risk. In times of crisis, LPs may default on their commitments, especially if the LP faces financial problems of his own or goes into administration. Sometimes LPs will just ask GPs to hold off making investments because they can't make the commitment and putting the fund into a kind of limbo. A concentration risk may be present when there are too few LPs, which may lead to excessive influence over the management of the fund. Thirdly, fund manager organisation. Some GPs may have an unclear ownership structure or an ownership structure which contains the seeds of potential future conflicts and problems, such as GPs with LPs as shareholders or GPs with a sole owner, for example. Fourthly, staff risk. Most of today's 8,000 or so GPs are typically operations with 10 to 20 staff, so even a few leaving has an immediate measurable impact on operations. If one of the two key senior people leave, that may trigger key man clauses and even lead to suspension of the GP's activities. Fifth, succession risk. As time passes, there may be differences emerging between founding and non-founding partners or frustrated staff not being promoted. This can lead to splits and spin-offs. The fund actually needs to keep raising funds to give enough work for everybody and provide promotion opportunities for everybody. Sixth, portfolio risk. The fund may end up making investments in too concentrated sectors or geographies. The fund may, on the other hand, make too many investments which become virtually impossible to manage properly. Seventh, regulatory risk. There is always the possibility that regulations may have an impact. In the past, we saw the 2010 Frank-Dodd Act and the 2011 European Union Alternative Fund Managers Directive. These mainly affected the very large buyout funds, but recent tightening up of offshore incorporation rules requires directors to have more substance, and this is very likely to affect a much wider universe of funds than Frank-Dodd or the European Union Directive of 2011. Luckily, private equity fund managers are instinctively good risk managers. It comes with the job. Unlike banking, the risk manager and the investment officer are the same person, which makes for much more rational decisions. And the key winning factor to managing GP risk is ultimately a strong investment committee. And there are much less of these than people think. I hope you found this interesting. As you may have noticed, the majority of risks described are operational risks rather than market or credit risks, and this reflects some of the complexities of the private equity industry.